The Chinese economy is in decline, yet its stock market is surging in a frenzy. This is no miracle, it is a carefully laid trap. Indeed, while countless businesses collapse, the real estate sector hemorrhages, and ordinary citizens' savings dwindle, China's A-share market soared to 3,787.98 points on August 21st, marking a decade high. The combined trading volume of the Shanghai and Shenzhen markets reached an astonishing 2.42 trillion yuan, exceeding 2.5 trillion for the seventh consecutive trading day. What does this signify? It suggests that hundreds of millions of Chinese investors are frantically pouring their money into what appears to be a thriving market but is in truth a perilous arena. With the real economy in such distress, why is the stock market skyrocketing? The answer is clear. This is an orchestrated boom. The government is manipulating the market, pulling funds from dormant bank deposits and funneling them into the volatile crucible of capital markets. Data from the People's Bank of China reveals that household savings dropped by 1.11 trillion yuan in July alone, while deposits in non-bank financial institutions surged by 2.14 trillion yuan. This indicates that money is not disappearing, it is being redirected, flowing from secure savings accounts into the treacherous waters of the stock market. More concerning still, in the first 7 months of this year, 14.5 million new stock accounts were opened, with nearly 2 million added in July alone, a 70% increase from the previous year. This signals that millions of ordinary citizens, squeezed by abysmally low bank interest rates, are being enticed by the prospect of quick gains and returning to the market's gamble. One might assume this reflects a nationwide investment surge. That assumption would be mistaken. Financial commentators have noted that this stock market boom is not a natural market phenomenon, but part of Beijing's tribute to the September 3rd military parade, a distraction now that real estate has collapsed entirely. The authorities have targeted the 151.25 trillion yuan in household savings, viewing these funds not as wealth but as untapped resources to be extracted and repurposed. Since its inception, the Chinese stock market was never intended to enrich investors. Its primary function is to finance state-owned enterprises. In essence, it is not a capital market but a mechanism for reaping retail investors cycle after cycle. In a robust capital market, companies drive stock prices through innovation and profitability, and investors build wealth through returns. In China, however, companies list primarily to raise funds, channeling private capital to shore up the deficits of state enterprises. Consequently, the A-share market moves in stark disconnection from economic fundamentals. The economy is contracting, exports are declining, and domestic demand is shrinking, yet the stock market balloons as if immune to these realities. What sustains this illusion of prosperity? Government policies, media narratives, and relentless waves of speculation. The 1999 5.19 rally serves as a stark precedent. Policy-driven surges led to a short-term boom, followed by a 20% crash within 6 months. Today's A-share trajectory mirrors that event almost exactly. The Chinese stock market is akin to a chamber pot, neglected in stable times, only retrieved during economic crises to create a veneer of prosperity. Yet what it holds is not pure water but tainted contents, and it is the millions of retail investors who are left to consume it. More troubling still is the overt financial coercion of ordinary citizens underpinning this market surge. Consider this. The one-year fixed deposit rate at China's 6 major banks stands at a mere 0.95%, among the lowest globally. Bank wealth management products offer an average annualized return of 2.12%, only marginally better. The result? Keeping money in banks is akin to a slow erosion of value. Investing in wealth products is a gradual depletion, and only the stock market dangles the fleeting promise of rapid wealth. This is the trap crafted by policy. Citizens are cornered into the market, as safer options are rendered unviable. Bloomberg analysts have observed that, with diminishing returns from real estate and declining yields from wealth products, the Chinese stock market has become the sole avenue for household asset allocation, a path not to prosperity but to peril. Consider the broader context. Bloomberg estimates that China's household savings total 151.25 trillion yuan, equivalent to 1.7 times the combined market value of the Shanghai and Shenzhen exchanges. If policies continue to redirect these funds, the market's capacity for exploitation remains vast. But why are these savings leaving banks? The real economy is faltering. Over the past 4 to 5 years, China's economic downturn has intensified. Authorities have resorted to loose monetary policies and aggressive interest rate cuts, flooding the market with liquidity. Yet this capital has not flowed into factories or consumer spending, it remains stagnant. Pessimism about the future deters businesses from investing and individuals from spending, leaving money idle in banks. But as bank rates plummet, citizens are compelled to shift funds into stocks, bonds, or speculative markets. This is not a sign of confidence but of desperation, not prosperity, but a lack of alternatives. One might believe this is a spontaneous market rally. That would be incorrect. Unlike Western markets, China's stock market is a tightly controlled, heavily manipulated entity. When economic indicators are universally declining yet the market thrives, only one conclusion remains: government intervention. The rally earlier this year, driven by hype around the AI sector, exemplified by companies like DeepSeek, touted as revolutionary, quickly fizzled as user numbers plummeted and the industry bubble burst. Yet, through propaganda and manipulation, the market was artificially elevated. This reflects Beijing's strategy. Even amidst economic disarray, a vibrant stock market serves as a polished report card to placate the public and signal to the world that all is well. However, the stock market is a tool for appearances, not salvation, and it is ordinary citizens' savings that are being consumed. Official data underscores the grim reality. In July, retail sales of consumer goods grew by only 2.1%, well below the expected 4.5%. Industrial value-added output rose by 3.2%, a one-year low. The real estate market is in dire straits, with new home sales plummeting 24% year-on-year in July and housing prices declining for 19 consecutive months. These figures lay bare the truth. There is no economic recovery, only deepening decline. Yet against this backdrop, the A-share market has been propelled to a 10-year peak. This is akin to a gravely ill patient, sustained by heavy painkillers, smiling through collapse. For 2 decades, China's economic boom relied almost entirely on real estate, with citizens pouring their life savings into property. Now, with housing prices crashing and giants like Evergrande and Country Garden crumbling, leaving behind unfinished projects and shattered families, real estate has collapsed as a fallback. Where then does the money go? The government requires a new reservoir, a new illusion of wealth. Thus, the stock market takes center stage. Economists have noted that authorities are executing a strategic pivot, transforming citizens from real estate scapegoats into stock market participants. The market is being repurposed as a tool to drain household savings, a process driven by political imperatives. Should economic indicators continue to worsen and social confidence erode, the authorities risk losing their last veil of legitimacy. The greater danger lies in the growing disconnect between this false prosperity and economic reality. Bloomberg has long cautioned that a market rally unsupported by fundamentals risks systemic collapse once confidence falters. The further stock prices diverge from reality, the more devastating the inevitable crash. This would not be a mere correction but a catastrophic unraveling. Retail investors bankrupted, life savings obliterated, company stocks plummeting, financing chains snapping, bankruptcy spreading, and financial institutions, brokers and wealth products imploding, triggering a broader financial crisis. Social trust would collapse, creating a vicious cycle. Should this occur, the impact could rival or exceed the 2008 U.S. subprime crisis, amplified by the fact that China's stock market is not a market-driven system but a politically manipulated tool. Its rise is artificial, and its fall could be an intentional harvest, a chilling prospect. Some view this rally as a chance for ordinary citizens to prosper. Reality tells a different story. Data indicates that retail investors account for over 80% of the A-share market, meaning the bulk of funds comes from ordinary people, not institutions. Yet in the past 20 years, retail investors have rarely, if ever, emerged victorious in China's bull markets. The pattern is consistent. Policy signals, media hype, retail investors rushing in, trading volumes surging, stock prices spiking briefly to create an illusion of profit, followed by institutional investors cashing out at the peak, a market crash, and retail investors left with losses. More unsettling is that this unfolds amid deflation. In July 2025, China's CPI fell 0.4% year-on-year, marking 12 consecutive months of negative growth. Deflation signals shrinking economic activity and vanishing consumer confidence. Experts have warned that a market crash combined with deflation could be catastrophic, not only collapsing the capital market but also destabilizing the banking system, local finances, and societal stability. Should this false prosperity implode, China could face a systemic financial crisis. For ordinary citizens, the implications are stark. Bank interest rates are negligible, real estate investments depreciate, businesses face a stagnant market, and the stock market appears as the only, albeit illusory, path forward. Yet, upon entering the market, one discovers it is not an opportunity, but a snare. Retail investors cannot outpace policy and are left vulnerable to unpredictable downturns. The promise of state-backed investment opportunities is a facade. In truth, citizens are positioned as expendable players. The most alarming aspect is that this is not an anomaly but a systemic inevitability. Today's A-share market resembles a grand gala, dazzling lights, booming music, and apparent jubilation. Yet behind the scenes it is a meticulously crafted deception. The economy is declining, consumption is contracting, real estate is collapsing, and deflation is spreading. When that day arrives, the heaviest toll will not fall on privileged institutions, but on the millions of ordinary citizens who entrusted their life savings to the market. The stark reality behind China's stock market prosperity is this: it is a crucible for retail investors, a realm where their hopes are consumed. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.